Well, hello there. My name is Michael Blanc, CEO of Nighthawk Equity, and a question we get a lot of times is how should we evaluate a multifamily syndication investment opportunities? And the biggest mistake I see people make is they will look at one deal, the returns of one, and compare them with the returns of the other. And that is the biggest mistake you can make because returns is really only the third criteria when you're evaluating deals. In this video, we're going to talk about what you should do to evaluate multifamily deals. And to help us unpack that is our Director of Investor Relations, Bronson Hill. What's going on, Bronson?
Howdy, Michael. Good to be with you. Good to be with our investors today. So you just said something interesting, and I'm not sure if I fully understand it. Maybe you could explain it for me. So you're saying only look at the returns. Like, what should I look at as a investor?
Yeah, I mean it's obvious. It seems obvious. Hey, you get a stock and you can compare the historical returns with historical returns of another one, and that helps you make the decisions. And of course, past performance is no indicator for how it will do early on. And multifamily is no exception, but it's a little more complicated with multifamily because there are other variables at play. So the returns is, in my opinion, only at the third level of criteria when you're looking at deals. There's really three. And the first and foremost is really the sponsor. Who is the sponsor and who's the team behind the sponsor? The sponsor is the operator, the syndicator, the one who is offering you the investment opportunity. So in my mind, and it's like the Gary Keller book, The One Thing. If you guys haven't read that book, it's fantastic. But the one thing really in analyzing and investing in multifamilies is the sponsor. Everything else flows that. For example, if you're investing with an experienced sponsor who's got a great team and great track record, well, are they going to pick a good market? Yeah, probably. Are they going to pick good deals? Yeah, probably. Are they going to operate the property very well? Yeah, probably, right? So which means that if you have a very strong operator you can trust, you can spend less time doing diligence on the market or the deal or whatever the case may be. Yes, you should still look at the deal itself, but really the operator is first and foremost the most important consideration. So as you're evaluating an opportunity, ask the question, who's behind the deal? And sometimes in this day and age, you have these large groups of general partners or joint ventures, and that's cool. We do the same thing, but we really want to know, well, who's actually who has the decision-making authority, and who's actually running the operation once it closes, right? And then who are those people, and who's behind those people? I'm not saying you shouldn't invest with someone who's never done a deal before or who's maybe done a few deals before, but again, you want to see the team behind them. So if you're investing with a new syndicator, then who's their property manager, right? Who are they using? What about their attorney, right? So start asking who's behind them. Do they have advisors? Now with us, of course, we have now track record and we have experience, so we can point to that, and not everybody can do that. But track record and team and the sponsor are first and foremost, Bronson. That's number one.
Yeah, Michael. So just to summarize, you said the really the sponsor team, the group, the partnership, the people that are putting this deal together is the first thing. What is the next thing? What's the next most important thing beyond the sponsor?
Yeah, the next one is the deal itself, obviously, right? And you're really looking if you're a passive investor, and I know this because I both talked to dozens and dozens of investors. When you're talking to a deal, the investor really is mostly concerned about loss of capital. Number one, right? Loss of capital. So it's really the downside. What is the downside of this deal, and what are we doing to protect you from the downside? This is a fair question to any operator. What are you doing to protect? What are the risks, and what are you doing to protect us from that risk? It could be the market. It could be whatever the case may be. And so to protect us from this risk, as I think you mentioned in another video, this Warren Buffett quote about this margin of safety, right? What margin of safety do we have built into a deal? And for example, in our deals, we have multiple margins of safety built in. And this is what I encourage you guys to look at and see, where are the margins of safety in a deal. And there's specific things you can look for and to ask about. Sometimes they're buried some deep in the financials and you don't really know what they are, but you should look for these points. And if you can't find them, ask them about that. For example, you want to have conservative underwriting. And there's a few things that you can look for. Number one, reserves at closing. In other words, cash at closing. You never want to run out of cash, either at any point. So we have a lot of reserves at closing, obviously to fund our renovations, but we have a buffer above and beyond that for unforeseen things going wrong during construction, for any kind of emergencies, a sewer leak or something unforeseen that happens. You always want to have money at closing. And then you also want to take money out of cash flow, okay? And you want to do this what's called above the line. So in other words, before you calculate the net operating income, I see a lot of people either not do that at all, which is bad, or they put it below the line, meaning that they exclude it from the net operating income. So we put it above the line, which of course reduces our returns. And this is an example of comparing returns. You can have someone with a 16% IRR, and they're not actually taking out cash reserves while they're operating it, and we might only have a 14% IRR, but we are. Okay, so you can't just compare apples to apples in that. You have to ask these questions as well. For example, and then the other one is rent growth. We see a lot of these deals coming out with $150 rent bumps in year one. No. That might be over a course of 3 years, because to get that rent bump, you'd have to literally vacate, throw all the tenants out, get every unit renovated like on day 2, and get them filled on day 3 to achieve that number. And we see this all the time. And of course, if you have a $150 rent bump in year 1, your returns are going to be extraordinary. Okay, in our models, it takes us 2, oftentimes 3 years to get those rent bumps consistently as well. And the other one, this kills me, is what's called a reversion cap rate. So the cap rate obviously is this multiplier that helps us determine the value of commercial real estate. And, in a lot of markets, it's 6%, 5.5%, whatever the case may be. So let's say I'm getting into a property, let's like the one we just did in December in Huntsville, and let's say the cap rate is 5.8%. Okay, great. So as I'm making my financial projections 5 years out, what cap rate am I going to use? Well, it's hard to say. We can't predict the future, but would it make sense, Bronson, to use a lower cap rate in 5 years?
No, not at all.
Well, it might. I mean, cap rates could still go down, but is it likely? I don't know, right? So we see these deals where the cap rate is exactly the same as they are now, or even better, they're lower. Oh, yes, the market is going to continue going up in 5 years. It's going down to 5%. Well, if I'm buying at a 5.8 cap and I'm selling at a 5 cap, I'm just printing money at this point, okay? And the returns are outrageously awesome, okay? And they're all horse manure, of course. And so we build in a margin of safety. We project at least a half point higher cap rate, meaning that we're projecting that the value of real estate is going down in 5 years, okay? And so these are multiple layers of margin that we build into our underwriting. And you should look for those margins of error as well, those margins of safety, really. And if you can't find them, then you ask the operator, hey, where are these things? Where are these margins of safety that I'm looking for?
Absolutely, Michael. That's great. I think, one thing that comes up a lot on the calls is just basically, you'll see a lot of deals and people are really underwriting for the best case scenario or things just to continue. But what we really try to do in our underwriting, and really conservative underwriters do, is they say, well, what happens if things slow down? Does a deal still make sense, or does it completely fall apart? So just the assumptions you're using, and those examples are really great that you gave. So thanks for sharing that. Just wanted to, as we wrap up this video, thank you again, Michael, for sharing some of the things that you shared. If you're an investor and this is kind of new to you, you're interested in, hey, how do I do multifamily syndication, or is it even worth it, or how do I compare that with the stock market? Check out a report that Michael put together. It's really great. It's at themichaelblanc.com/report. themichaelblanc.com/report. It's a report that compares like the performance of the stock market and multifamily syndication. You'll find it very interesting. Take a look at that. If you are interested in taking the next step, you're like, I'm ready, I want to find out what kind of deals you guys are doing at Nighthawk, you can go to nighthawkequity.com, click the join button. We'll set up a call with you. We'll start a relationship. We'll get you on our deals list, and we'll be able to work together an upcoming deal. So we always say the best investment is the investment that you make in your own education. So thanks for taking this time to be with us, and we look forward to seeing you on the next video.
Hey, and before you go, make sure you subscribe to my YouTube channel, because we're putting stuff out every single week. Also, check out this special report just for you. It's what's the best investment, the stock market or real estate? It's going to blow your mind. And here's another video for you to check out.